Welcome to the morning market review. My name is Russell. I'm Senior Market Specialist at FXCM. My email address rshore@fxcm.com. Today is Tuesday, the 24th of May, 2022. I'm just going to bring up our high risk investment warning, and I'm going to keep this on screen for a few moments. And let's just bring up our market commentaries disclaimer. And just finally, our references, which would be MarketScope, CNBC, and TradingView.com. So let's just start off with the CNBC article, which has the headline as follows: European markets head for low open as comeback rally remains out of reach. European stocks are expected to open lower as the US market struggles to maintain a comeback rally. The negative open expected in Europe comes as global markets struggle to sustain a comeback rally following weeks of losses. US stock futures fell in overnight trading Monday, although stocks had rallied stateside earlier in the trading session, with the Dow jumping 680 points, or nearly 2%, following a week of sharp losses. The S&P 500 rose 1.9%, and the Nasdaq composite gained 1.6%. European stocks also trading higher on Monday, despite fears over the global economy dominating market sentiment of late. Markets in Asia Pacific were subdued on Tuesday morning. The World Economic Forum is taking place in Davos this week, bringing together political and business leaders from around the world. This year's summit comes after several years of COVID-19 pandemic and amid Russia's invasion of Ukraine, which is at top of the agenda. On Tuesday, CNBC will be speaking to a wide range of leaders. All right, so, well, if anybody's interested, they are going to be speaking to the chairman of the publicist groups in Standard and Chartered, CEOs of Nokia and ABB, etc. On the data front in Europe, flash purchasing managers index data for the Eurozone in May is due. Flash data is about 80% of the completed surveys. Okay. All right, let's bring up some charts. So the first chart I just want to show you is the Aussie. We'll get into the risk markets in a moment. The reason I'm showing Aussie is I do have a position in it. So I just want to show you sort of my thinking there. I don't take it as buy or sell advice. I have no idea whether this is going to be a profitable trade or not. So it's certainly not advice. I just wanted to show you. This is the daily. In fact, let me do it over here. I'm just looking 1, 2, 2, 3, and I'm hoping to get the sort of swing down. And if you go through to the hourly, you can see that it looks as if I'm about to cut this position, but I just wanted to show you the trigger there. We were already in a, we already had a stochastic coming down. What am I concerned about? I'm concerned about the fact that we are moving out of the lower quintile here. So the downwards momentum that I need to make this a successful trade is waning. Okay, so if the momentum is waning, well, then the likelihood of the downswing materializing diminishes considerably. Okay, so then why be in the trade? So then you may as well cut. So if the EMA is over here, just cross over positively, I'm gonna cut the position. Again, don't take this as a buy or sell advice. Again, I have no idea whether this is going to be a successful trade or not. I've applied money management, I've applied a stop loss, I know how much I'm prepared to lose. It's just something I wanted to show you guys. If you take a look at the weekly chart, you have got a fairly weak Aussie here. Okay, so that's moving to the downwards momentum as well. The obvious concern is, well, we're not quite in the bearish zone yet. However, I was looking at this as a potential suspicious rally, and when I got this crossover here, I thought it would be a good opportunity to perhaps see if I can take advantage of that. We'll see if it pans out, or if it doesn't. If it doesn't, no worries, I'll just cut it straight away. All right. Let's go back to the Dow. All right. So the Dow wasn't as weak as I thought it was going to be yesterday. What I want to do here is just add the pivots, the historical pivots. So let's just do that. All right, so I was looking for a reaction off of the R1, which is this green pivot over here. It hit the pivot. I was watching it carefully. There was resistance there. You can see it hit it 1 hour, 2 hours, 3 hours, 4 hours. The 5th hour it took it out. But now it looks like the momentum is starting to wane. See that? So let's just clean this. Let's just clean this up. So I'm going to change it from historical to just today. So it's easier to see. And okay, we've just gone top of the hour. So the cash market's open for Europe. We'll take a look at the DAX in a moment. But the idea here is we've now got the weakness that's potentially setting in. In other words, I think the rally off of Friday's low could potentially be what we call a dead cat bounce, right? What's a dead cat bounce? Is a bear market rally. Okay, this is just a sort of a novel way of saying that the rally is suspicious. Okay, in other words, there could be a potential opportunity here, but we can't guarantee the opportunity. So because we can't guarantee the opportunity, we always trade with stop losses. We always trade with money management. If you don't have stop losses and you don't have money management, it's a disaster waiting to happen. I promise you. I know I've blown up a few accounts in my time, so just be very, very cognizant of that. So what we want to do is we want to just acknowledge the crossover here. We want to acknowledge, okay, the stochastic is moving down. And what we want to do is we want to see if the momentum heads towards 20. If it heads towards 20 and holds, then I fear the next leg of this market, and I'm talking about a bearish leg, may be manifesting. Let's go through to a higher time frame. So we, instead of doing a top down, we're doing a bottom up. We can see the weakness is starting to seep in, right? We can see it starting to seep in here. We go through to the daily chart here. A weakness persists on the daily chart. Now this chart, okay, Zanetta is just pointing out to the US dollar. So we'll take a look at the US dollar, Zanetta. Let's just analyze the daily on the US 30 here, and the daily is in the bearish zone. What's the bearish area? The bearish area is between the blue and the red Bollinger Bands, but this is not a Japanese candlestick. We're not looking at Japanese candlesticks here. We're looking at Heikin Ashis. Heikin Ashis are trend following indicators as well. I think one of the ways to use this, again, I want to suggest it's not infallible, okay, but is to look for strength within downtrends, because those are potentially suspicious, suspect, and exploitable. What am I talking about? Remember, Heikin Ashi is trend following. The colors here are important. Now, we've got red, so starting all the way back in April, red in zone 3. Then we get blue in zone 3. In other words, rally in downtrend, then the red continues. Here's the blue, rally, downtrend. Now we've got blue, okay, potentially rally in downtrend. Now, remember what I said, it's not infallible. If we cross from zone 3 into zone 2, that's strength, okay? Then potentially the trend is changing up. But as long as we stay in zone 3, okay, then the candlestick colors from red to blue become interesting, because they may revert back from blue to red. Blue to red is the next leg down. Go back to the hourly chart. Okay, go back to the hourly chart, which is hanging. Give me a moment here. Which subsequently crashed. All right, let me just get this restarted. I'll go to having all sorts of technical issues this morning. All right, let's bring up the US 30 here. We'll bring up the FXCM US 30. And I want to go down to the hourly, because that's what we were talking about. And okay, so we've got just while my market scope's rebooting, we got, remember the daily, we've got the blue in zone 3. Okay, we've got the blue in zone 3, but the hourlies are still already started rolling over. Okay, it's already started rolling over, and I am concerned that there is a false sense of safety from this bounce, and that's exactly what we spoke about yesterday, isn't it? It's that false sense of safety. We don't want to be trapped by it. We want to exploit it. Okay, we want to exploit it. My chart's back up, so let's. All right. So now, how do we know if we're wrong? How do we know if we're wrong? I'm going to go back to the Aussie. I'm going to go back to the Aussie. Okay. And you're wrong if the trend following indicators tell you you're wrong. Okay, so I have a short position in Aussie. It can be wrong. How will I know if it's wrong? If I get a positive, cross here. So we can see we are at this central pivot. I now need to see if the central pivot acts as a resistance area for my position and helps me along. If it doesn't act as resistance, I have no choice but to close the position. Okay, got no choice, have to close the position. I'm wrong. Okay, in the market, it's okay to be wrong. Okay, now Zanet has just suggested let's take a look at the US dollar, because of course, if we're looking at the Aussie US dollar, well, then the quote currency here is the US dollar. So US dollar is clearly a factor here. So what we can do is we could go down to the FXCM US dollar basket. Let's take a look and see what's happening here. All right, so she's using the 30. I'll take a quick look at it, but go back to the hourly. And what she's written here is that the US dollar is bearish on her 30, and I would agree with that. It seems to be bearish to me as well. Why would I say that? Well, on the 30, my trend following indicators are down. Okay, my momentum indicator is down. It's not quite as bearish as I need it to be. I need it, Zanetta, to be in 20 over here and hold. That's where the magic happens, right? If we get to the 20 area here and it holds, that's the momentum push. Okay, look what happens here. That's the momentum push. Okay, so we just kind of keep an eye on that. Now, so the fact if the US dollar, okay, moves into this 20 area here and kind of sustains down here, well, go back to my Aussie. Okay, go back to my Aussie. Well, that's going to probably be a problem. It will be a problem for me because I'm inherently short Aussie. If I'm short Aussie, well, then I want to be long US dollar. But that 30-minute chart, just to be clear, is showing perhaps the US dollar not performing in the direction that I need it to be. And that could be another sign of danger. Again, for me, my exit will be on the hourly. At the top of the hour, if we get a crossover here, I have no choice but to exit. It will be a nothing trade. I'll probably get a pretty close to break even here. It will be a nothing trade. So that's just something that we need to keep reiterating, I guess, is just the money management. By the way, whilst we're talking about this, just something that I think is worth expressing as well is that most trades are going to be nothing trades, and we've got to be happy with that. The money is not on the money is not on the first standard deviation. The money's in the tails, right? The money's in the tails, which are much harder to not harder, just much less common. It's a better way to put it. So most of your trades are going to oscillate around your average. Okay, 68% of the time. So 68% of the time, you're going to be one standard deviation to the left average, one standard deviation to the right of average. Those are nothing trades. They're not going to make you money. They're not going to lose you money. They'll just cancel each other out. The trades that make you money go past the first standard deviation, and the trades that lose you money go past the first standard deviation to the left. But that you can't allow that to happen. Okay, that's the key. You cut off the left tail. Must cut off the left tail. Okay, because if you cut off the left tail, then the distribution curve changes. Okay, the distribution curve looks like this. Okay, and this is a positive slope. Okay, so that's what we call positive expectancy. This is what you've got to try and do as a trader. You've got to cut off the left tail, and you've got to keep the right tail intact. And that's why take profits probably not a good idea, because it's going to compromise the right side of the tail. But that's something we'll discuss another time. This kind of distribution is actually probably doing trading justice, by the way, because we probably don't have a normal distribution. We've probably got a negative distribution in trading. Not probably. I'm almost certain that. So you've got to try and turn the negative distribution into a positive distribution. The only way you can do that is to be really brutal with your money management. Okay. All right, let's pop this down. Let's go back to, there's a comment here so first, Zanette is saying Aussie, she's looking at strong resistance on the Aussie. Rob saying that he looked at the Aussie yesterday and stayed out because one of the guys comments through negative interest rates being removed, stronger euro, weaker US dollar. 2, Aussie new government and policy undecided. 3, Aussie the commodity which is strengthening. Any thoughts on my logic? Let me ponder, Rob. Those are all excellent comments. Because I'll give you my thinking on it. My thinking actually does start with US. And it starts with the US dollar weekly chart. So what I was looking for yesterday is what I was looking at yesterday was, let me bring up trading view. Let's bring up US dollar here. All right, I want to go through to the weekly here. And then I'm going to bring in the US 10-year as well, which is on the right side. And I want to bring in an RSI on my left side. System's so slow to go, my apologies. And then, so one of the things I've been concerned about with the dollar is the weekly chart being overbought, okay? And for me, you know, that's an issue because it's very difficult for an instrument to remain overbought or oversold for long. And the only reason that it would stay overbought or oversold for extended period of time, such as Bitcoin, is because there's an unhealthy exuberance that's associated with the instrument. So all things being equal, I would need to see some sort of normalization in the RSI, which actually has started taking place. And the reason that I think this is important is because the overbought condition effectively placed a ceiling on the US dollar. Now we're looking at a weekly chart here, okay? So we're looking very long term. Now, weekly charts are good to examine when we consider the fundamentals. We want the long-term trend to sync up with the fundamentals. And I think that's best seen on the weekly chart. At the same time, we had a very strong increase in rates, but at a rapid pace. We jumped over a 7-week period, sort of from under 2 to over 3, maxing out at 3.2 and coming down now to about 2.8. And what's happened here is the yields are starting to find some sort of support, but importantly, they've normalized from this overbought condition. For me, dollar is certainly the driver of the markets at the moment. Again, I want to tag on subject to correction because, yes, looking at Christine Lagarde talking about Euro monetary policy, that they're going to come out of zero imminently. The fact that there is now a Labour government in Oz as opposed to a Liberal government, yeah, that certainly can have a impact, no doubt about it. For me, though, the dollar is really kind of where the story is at the moment. Why is it where the story is? Because my thinking is that so what's the US 10-year telling us? It's telling us that perhaps the Fed's going to max out their rate hikes at around 3%. Okay, the long term. I don't necessarily think that the Fed has that luxury, personally. I think we may see rates go all the way up to 4%. Okay, makes it. But we can't just go up to 4%. It doesn't move in a straight line. We need to see some sort of normalization. We have to see the froth come off. We have to see the inevitable banking of profits. Okay, so the US dollar longs, they've started banking profits. Why wouldn't you? Look at this gain. The bond market participants, well, the guys that have effectively been short bonds, they're probably going to be starting to bank profits. Why wouldn't you? You've had 7 weeks of absolute terrific gains as a bond market short. So the idea here is, okay, that I'm not sure that the dollar is quite finished with its run yet. And I was thinking that I would try getting on the pullback. So I went to the, I went down to the majors, and I was seeing, well, where is there a potential for me to take advantage of a dollar pullback? Okay, where is there and for me, the opportunity came with Aussie. Why did it come with Aussie? Just on the hourly figures. Okay, again, that's premature. That's okay. I'll have to close it here. Okay. So that's the kind of my thinking at the moment. I'm not sure the dollar story is done. I don't think that the hawkishness of the ECB is anywhere close to the hawkishness of the Fed. I would also suggest that the politics in the ECB are a lot different to the politics in the Fed. Remember, a lot of the European countries are holding a lot of debt, so there's friction within the within how far European rates can go. Yes, we'll get lift off in July. Yes, President Lagarde said that they're going to push towards 2%. She also said that if they go, if they can't control inflation, they'll go past neutral. Okay, I'm not so sure that she's got the full support of the ECB behind her. Nevertheless, what you say, Rod, is very much, I think, pertinent. It does seem to be supporting the euro at the moment, does supporting the euro at the moment, and the Aussie does seem supported as well. So I think that your reading of the situation's probably spot on. What I would be quite interested in is, well, how far is the euro going to move? Okay, because we're in a primary downtrend for euro. Okay, is the ECB change in policy from doves to hawks going to be able to give us a trough higher peak? And I would suggest, of course, if it does do that, then my assessment is incorrect, and euro is strengthening relative to the dollar. So, but at the moment, looking to see if this rally in the euro is effectively exploitable. Looking to see if any rallies in the Aussie are exploitable, and that's just the way that I'm going to approach it until the dollar story seems to have been maxed out. Zenet is saying there's Euro news at 8:30 in 10 minutes. All right. KD just saying, what's the reason for the NASDAQ sell-off? Okay, let's go through to NASDAQ. All right. So there's a big gap down here in NASDAQ. Big gap down here in NASDAQ. let's start off speaking just as technical analysts, Katie. Let's just talk about this in terms of technical analysts. It's very important. This is very, very important. I must stress this, that if you approach the market, I would suggest a top-down analysis is a must. Top-down analysis is a must. This is, to me, a critical. It's not only in technical analysis that you would do a top-down analysis. Fundamental analysts would do exactly the same. They would start off on the macro level, and they would slowly work down to the micro. So they'll look at the macroeconomic fundamentals, they'll look at the industry fundamentals, they'll look at the firm fundamentals, but they're working their way downwards. So there is another style called bottom up, but generally you'd follow it a top down. And I think that it's very important in technical analysis to do a top down analysis for the following reason, okay? In that the shorter term swings are very much influenced by the primary trend. It cannot be any other way if you really think about it. It must be this way. A primary trend is going to take you from the bottom to the top and from the top to the bottom, but it's not going to take you there in a straight line. There's going to be ebbs and flows, and those are what we call secondary trends. Okay, there's even a Dow called under the secondary movements you'd have what Dow called noise. I would say that it's probably changed because of the sort of algos and the the platforms we use now, which obviously weren't around when Dow was. But in other words, to get from the bottom to the top, the impulses, the movements up must be stronger than the pullbacks. They have to be. They have to be stronger, because otherwise you're not going to get from the bottom to the top. Sort of like a wave structure, right? In a bear market, to get from the top to the bottom, the impulses, which would be your down moves, have to be stronger than your pullbacks. Otherwise, you're not going to make any headway to the bottom. So, in other words, the shorter term market needs to be influenced by the primary trend. Otherwise you're not going to get anywhere. You're going to be range bound. Okay, so that's the first thing that we need to acknowledge, Katie. So if that is the case, then we've got to know what is the primary trend. Because once we know the primary trend, we can go down to the level below it. Okay, so there's many ways you can do it. For me, I just choose to do it on the weekly. You can, of course, go very high level and start looking at monthly. Okay, you can start looking at monthly. I think that weekly over here works quite well. Okay, now what kind of trend do we have here? Now we're looking at NASDAQ longer term trend, Katie. So the way we do that is peak and trough analysis. Why do we use peak and trough analysis? Because that's ultimately what's going to determine trend. That is what's trend. So trend's down. Trend's down. Okay, so we know trend's down because we've got a lower peak, lower trough. Next question though is, okay, so what the downtrend? Where's the momentum? Where's the momentum? Well, for that we use stochastic. That's my indicator of choice. Okay, everybody, whatever indicator you use, you've got to be comfortable with it and you've got to understand it. And I think that the stochastic's a really easy indicator to understand, and I think it does a terrific job in measuring momentum. Where is it? Well, it's in the lower quintile. Okay, it's in the bottom fifth of its range over the last 15 weeks, and it's maintaining there. So that suggests that the momentum is down, and it's quite viciously down on a longer term chart. It's going to lag. This is a slow stochastic, so it's going to lag. So by the time that we get a reading that it's moving out, that the momentum is sort of becoming more positive, we'll be behind, but that's okay. We don't have to be at the bottom. We don't have to be active at the bottom. We don't have to be active at the top. Okay? We just have to be active for the majority of the move. So we've got here a downtrend, and we've got very strong momentum. Now that's, to me, dangerous. Right away, that's telling you that it's dangerous. So next thing we can do is, okay, well, we've got the very top. Let's take a look at the next level down. Well, let's go to the daily. Okay, so here we use slightly different indicators, what we really want to do is we want to just sync up. What we really want to do is we want to try to sync up the intermediate with the longer. This does the job fairly well. Again, it's not infallible. But what do you see here? We've got two trend following indicators here. We've got the Heiken Ashi. What color are they? They're red. Red's down. That's what's so cool about the Heiken Ashi. It's just a very visual. It's a very visual indicator. Well, okay, it's down. In which zone is it? It's in zone 3. That's our weak area. So we know that the weekly chart is telling us we've got very weak momentum. We know that we're in a downtrend. But that's all being corroborated by our daily. It's all being corroborated by our daily. So we know we're in a weak market technically, right? Then if we're in a weak market technically, hourly becomes exceptionally important for us in terms of timing, because until we get some sort of indication on the higher time frames that we're out of the out of weakness, it's really going to be the prevalent determinant of trend. Must be. Why must it be? Because we're going from the top to the bottom until we won't know we're at the bottom until after the fact. To try and pick the bottom here is going to be painful because we don't know where the bottom is. We might be there, we might not be. Okay. So, well then, all these rallies become super interesting because they're exploitable, because they could be what we call bear market rallies. So technically speaking, the sell-off in Nasdaq kind of makes sense, okay? Because they're going to be targeted by the shorts. Why are they going to be targeted by the shorts? Can't be any other way. The pressure's to the downside. Okay, so that's it on a technical level. That's it on a technical level, but that's not good enough. We've got to understand it on a fundamental level. We must understand it on a fundamental level. So that is where yield comes in. That is where yield comes in. So let's go here. Now, you can see that yield here was overbought. It's pulled back. It's pulled back, but it's found support. If we go through to the daily here, it's found support. Okay, and yesterday it was up. Yesterday, if I zoom in here, it was up. Okay, it was up. Not a lot, but it's kind of stopped going down. It's up. So what is the fundamental telling us for Nasdaq? Well, yield is everything, okay, at the moment, because it is all of a sudden it's what we call positive real yield, and the way that we do that is we'll just take the US 10-year. We'll minus a break even. Again, we have explored this previously. It's perhaps something we'll explore tomorrow. I'm just cognizant of time, but if we just minus the normal from the 10-year, we'll come up with something that we call real yield. And what I want you to note here, KD, is it's positive. It's minute. It's only 0.26%, but it's positive. Okay, that's actually huge because it was negative. It was negative for a really, really long time. Here's 0. Okay, so the fact is we've got positive real yield. So okay, let's just reiterate. Let's go through this one point at a time. First point, we know that technically the primary trend is down. If the primary trend is down, then short-term rallies are suspect. If short-term rallies are suspect, then they are exploitable. But they're not exploitable doesn't mean we're definitely going to make money. That's why we use stop losses and risk management, right? But now we've got to apply some just basic mathematics, okay? Just got to apply basic mathematics, okay? And unfortunately, there's no getting away from this. We must understand this, and if you don't understand it, just go into YouTube and type in time value of money. You'll get a video on it. But make sure that you understand the time value of money. It's very important, specifically when you're looking at something like the Nasdaq, because that's what we call a growth index. It represents growth stocks. And let's just understand the next phase of the analysis here. companies tend to have a cycle like this. So we'll have something like this, kind of something like this. So you'd have kind of your let's call this the embryonic stage, embryonic. I hope I'm spelling this right. Embryonic. All right, I don't think I've got it quite right. All right, but then we move into what we call growth, and then of course here's your mature. Here's your mature. Okay, so this is Nasdaq. Nasdaq's here. Okay, this is Nasdaq. And to kind of grow, what you would find is that your company is going to have a very low payout of dividends. It should have a low payout of dividends because it wants to retain that money to reinvest in the business, and that's why they're growing. It's because they're reinvesting inside the company. They're growing. They'll reach some sort of level where they become mature, and then they'll start distributing profits to shareholders. Okay, but right now we're kind of over here. So the fact of the matter is, dividends are going to be paid in the future. We're talking. So if you buy a blue chip company that's been around for the last 100 years, you're going to get a dividend. Most likely, you'll get a dividend, right? You'll get a dividend. Okay, that's not what's going to happen. It's not what's going to happen with a growth company, because the growth company can't afford to pay dividends yet. It has to retain that money. So that's very important when we talk about Nasdaq, because we have a formula. Again, just Google time value of money, but present value of your stock equals, we'll just call it dividend divided by 1 plus, and we'll just call it interest for the sake of this conversation. And then let's say we're only going to get the dividend in 5 years. That's what N is. Okay, so N is your timeline. So for growth companies, the fact that your N is much further in the future than for mature companies means that they're much more sensitive to interest rate changes, much more sensitive. If you do the mathematics, you'll find that the fact that your N is so far in the future is that any change in R makes a bigger difference on your present value of the stocks. If it makes a bigger difference on your present value of the stocks, it means they're more sensitive to what we call duration. Believe it or not, duration means sensitivity to interest rates. So high duration stocks are your Nasdaq, are your growth stocks. It means that when there's a change in interest rates to the upside, they're going to get hit harder than your mature companies. But when there's interest rate changes to the downside, they're going to benefit more than the mature. Okay? Do you get that, KD? Because that's the answer here. You can see that your interest rates are starting to move positively. Look what's happened to Nasdaq. Bam. Getting smashed. Not only is it getting smashed on a fundamental level, it's weak on a technical level. Okay. By the way, there is going to be a time when there's going to be super value in this market. Okay. There's going to be times when we take a shopping trolley and go to town. I don't think that's the time right now. Right? So, but that's effectively what's happening in the markets, is that the present values are getting hit really, really hard at the moment because of your interest rate, and it's a high duration index. Okay. All right. What I'll do is I'll take one more look at the Aussie to see if I'm going to have to close this down. Yeah, it's looking like it's going to have to be closed. All right. And I think that's where we'll leave it for today. We've been going on for about an hour. The first part of it I'm begging your pardon. We were I had those technical issues. Thank you, Anna, for assuming responsibility for keeping the webinar running. If there's anything, just shoot me an email and we will do this all again tomorrow. Have a good day ahead, guys.